Warren Buffett was able to generate a 33% return annually for 18 plus years in this private company that no one knows about, no one can actually find information about because he did this in his private account. We're gonna go over Warren Buffett's value investment process because Alice breaks this down perfectly. Alice was the author of Snowball, a book about Warren Buffett's business life and his investment process. Go read the book if you haven't. And in this 2008 Value Investing Conference, she talks about the holy grail about Warren Buffett's process. She spent over 2,000 plus hours with Warren Buffett. She got to read all his business files. She got to ask any questions she wanted to Warren Buffett himself. So she has the best overall picture about his value investment process. So we're gonna break it down with this one company. Let's get into this video and let's hear what she has to say about Warren Buffett's process. Everyone always wants to know about Warren Buffett's process because he said if he had a small amount of money, he could get 50% annually returns, which is insane. So people always want to know what's the holy grail to this? What's the strategy? And Alice kind of breaks it down when she talks about one investment that generated 36% return.
So what happened was that IBM did actually settle with the Justice Department. And as part of that settlement, it was required to divest of a business making tab cards. Okay, so a tab card is, before computers were digital, they actually read off of punch cards. They were called mark sense cards, and these were big decks of cards that had holes punched in them, and they would be stuck in the computer and they would be read manually by, or not manually, they were not electronic, they were sent mechanically through the computer. So this company was formed because IBM had to divest of this business. It was an incredibly profitable business. In fact, because these cards were trivial compared to the mainframe computers that IBM sold, it marked them up to get more than a 50% profit margin. This was IBM's most profitable business. So Wayne Eves and John Cleary, who were two friends of Warren's, saw that IBM was going to have to divest in this business, and they thought, we're going to buy a Carroll press, which was the press that makes these cards, and we're going to compete with IBM because we're based in the Midwest, we can ship faster, we can provide better service. And they went to Warren and they said, should we, invest in this company, and would you come in with us? And Warren said, no. Well, why did he say no? He didn't say no because it was a technology company. He said no because he went through the first step in his investing process. And this is where I think what he does that's very automatic but isn't well understood. He acted like a horse handicapper. And the first step in Warren's investing process is always to say, what is the odds that this business could be subject to any kind of catastrophe risk that could make it just fail?
And that's one of his secrets because Warren Buffett always says, Charlie Munger always says that he avoids IPOs because they just don't have the history of performance. And Warren Buffett really wants to know the history of performance before he kind of invests in a company. He wants to dig deep into that. So if it doesn't have a history of actually outperforming, then he doesn't really want it because he's usually looking at monopoly type of companies. And the only situation where people are saying that he invested in like an early kind of startup kind of company, but it wasn't really a startup, was BYD. And he had crazy like kind of information about BYD from Lou. So who knows if that's even a good example of this, but yes, he's trying to avoid the huge, big risk. And you're gonna think about it, if you try to avoid this risk, in 2021 and 2022, you would have avoided so many damn unprofitable companies, man. If you think about what is the worst thing that can happen with this company, you would have avoided so many damn companies this year and last year.
And if there is any chance that any significant amount of his capital could be subject to catastrophe risk, he just stops thinking, no, and he won't go there. And it's backwards the way most people invest, because most people find an interesting idea, they figure out, the math, they look at the financials, they do a projection, and then at the end they ask themselves, okay, what could go wrong? Well, Warren starts with what could go wrong. And here he said, a startup business competing with IBM could fail. Nope, sorry. And he didn't think another thing about it. But Wayne Eves and John Cleary...
Man, the downside risk protection is so critical. A lot of investors don't even do this. They look all about the upside, and that's what I'm going to be working on more in 2023, looking at the downside first.
Went ahead anyway, they started up this business, and within a year they were printing 35 million tab cards a month. So that at that point they needed to buy more Carol presses. They came back to Warren and they said, we need money. Would you like to come in? Okay, so now Warren is interested because the catastrophe risk element of the equation is gone. They are competing successfully against IBM. So he asked them the numbers, and they explained to him that they are turning their capital over 7 times a year. So a Carol press costs $78,000. Every time they run a set of cards through and turn their capital over, they're making over $11,000. So they're basically their gross profit on a year on a press is enough to buy another printing press. At this point, Warren's very interested.
So the gross profits are high, and he likes to invest in these capital-light businesses that generate high profit. So this is critical again.
Profit margins are 40%. It's like the most profitable business that he's ever had the opportunity to invest in. Notably, people are now bringing Warren special deals. It's 1959. He's been in business for 2.5 years running the partnership. Why are they doing that? It's not because they know he's a great stock picker. They don't know that. He hasn't yet made that record. It's because he knows so much about business and because he started so early that he has a lot of money. So this is something interesting about Warren Buffett. By 1959, people were already bringing him special deals like they're still doing today with Goldman and GE. He decided that he would come in and invest in this company, Mid-Continent Tab Card Company, but interestingly, he did not take Wayne and John's word for it because the numbers they gave him were really enticing, but again, he went through and he acted like a horse handicapper. Now, here's another point of departure from what almost anybody else would do. Everybody that I know or knew as an analyst would have created a model for this company and would have projected out its earnings and would have looked at its return on investment and da-da-da in the future. Warren didn't do that. In fact, in going through hundreds of his files, I've never seen anything that resembled a model. What he did...
Guys, do you think he does a DCF in his mind? He probably just does a DCF in his mind very quickly. Mohnish Pabrai says the same thing. He doesn't use a DCF model. He just looks at the business and sees like how undervalued the company is by just doing a simple like kind of cash flow in his mind. So I wonder if he just does it in his mind quick because he's a genius. So he probably just does that very quickly.
Did is he did what you would do with a horse. He figured out the 1 or 2 factors that could make the horse succeed or fail, and in this case it was sales growth and making the cost advantage continue to work.
And that's critical. He wants the cost advantage to continue to work. Just imagine that, and that's all about the moat. If that moat is still there, that cost advantage, people are just going to continue to go back and back again. Think about it like Costco. That's it right there. Like he wants a moat. So he had that sales growth plus a moat, plus it was a profitable company already. All engines are just firing.
And then he took all the historical data, quarter by quarter, for every single plant. He got the similar information as best he could from every competitor they had, and he filled pages with little hint scratches of all this information, and he studied that information. And then he made a yes-no decision. He looked at it. They were getting 36% margins. They were growing over 70% a year on $1 million of sales. So that's where the historic numbers, he looked at them in great...
70% a year. Like, can you imagine that? Like, that's going to compound very, very quickly. Can you imagine it's 70% a year for like 3 or 4 years? And then in like the 5th or 6th year, maybe it goes down to 20 or 30%, but that's still crazy. And this was an early kind of startup company generating those returns.
Detail, just like a horse handicapper studying the tip sheet. And then he said to himself, I want a 15% return on $2 million of sales. And then he said, yeah, I can get that. And he came in as an investor. Okay, so what he did is he incorporated his whole earnings model and compounding discounted cash flow into that one sentence. I want 15% on $2 million of sales. Why 15%? Because Warren is not greedy. He always wants a mere 15% day one return on investment, and then it compounds from there.
So guys, that 15% return is what he wants. So that's building in a margin of safety, just having that huge goal of a 15% return, because if he doesn't get that 15% return, he's still probably going to get like a 10 or 11, and that's still really good. He's building in the margin of safety just by the fact that he wants a 15% return.
That's what all he's ever wanted. He's happy with that. You're not laughing. What's wrong? And it's a very simple thing. There's nothing fancy about it. And I think that that's another important lesson, because he's a very simple guy. He doesn't do any kind of, discounted cash flow models or anything like that. For decades, he just says, I want a 15% day one return on my investment, and I want it to grow from there. Ta-da! And the $2 million of sales was pretty simple too. It had $1 million, it was growing 70%. There was a big margin of safety built into these numbers. It had a 36% profit margin. He said, I'll take half that. And he ended up putting $60,000. I'm thinking in more modern terms. He ended up putting $60,000 of his personal non-partnership money into this company, which was about 20% of his net worth at the time.
20% of his net worth. Woo-hoo! Warren Buffett was not playing, and that goes into that he doesn't really diversify when he sees a home run. The same attitude that Charlie Munger has. If he sees a home run, he wants to put everything, all the chips inside. I'm not sure if you guys should do that, because we're not Warren Buffett or Charlie Munger, and I even did that, but still, that is crazy. 20% of his personal portfolio.
He got 16% of the company's stock plus some subordinated notes. And the way he thought about it was really simple. It was a one-step decision. He looked at historical data, and then he had this generic return that he wants on everything. It was a very easy decision for him. And he relied totally on historical figures with no projections. I think
that's key, no projections, because remember, guys, the future is just unknown. So if you're getting a 15% return day one, that's what you want. And if you can get 5-6 years of growth, you're perfect. You're golden.
A really interesting way to look at it, because I saw him do it over and over in different investments. So what happened? Well, the company changed its name to Data Documents. He owned the investment for 18 years. He ended up putting another $1 million into it over time. It was bought out by Dictograph in 1979, and he earned a 33% compounded return over the 18 years that he owned the investment. So it was not too bad.
So you can just see from how Alex broke that down, how that was an amazing investment from Warren Buffett. He got the proper intrinsic value. He got a nice margin of safety. He avoided the huge risk when it comes to this company. He hit all of the boxes, man. He didn't diversify when he found an opportunity. He put a 20% position into it right away, no hesitation, and he invested more as the company got better. So guys, he hit all the marks. That 15% return was kind of critical for his investment thesis. This was a Phil Fisher / Ben Graham type of investment, because he found a company with all the qualitative factors, plus it had a huge bargain attached to it. So it hit all the boxes, guys. So guys, tell me what you think about this video. Like it and subscribe to my channel. Peace.